When you look at the 200-year-old legacy commercial real estate firm, you expect steady dividends and, well, kind of sleepy growth.
Right, definitely sleepy.
Yeah, you absolutely do not expect a company aggressively riding the artificial intelligence wave, like capitalizing on hyperscale data centers and posting what are essentially Silicon Valley level earnings growth numbers.
No, you really don't. It's wild.
So welcome to a special extended Talk Tickers format deep dive. Today, our mission is to break down Jones Lang LaSalle's Q2 2026 earnings call, specifically for you, the retail investor.
And we're pulling this directly from the official Q2 2026 earnings call transcript and the supplementary earnings text for JLL.
Exactly. And for this deep dive, we are keeping the Talk Tickers ethos front and center. We're going to be heavily data forward. We'll translate all the dense Wall Street jargon into plain language, take an opinionated stance, and figure out exactly what this means for your portfolio.
Because JLL isn't just managing buildings anymore. They're actively swallowing market share.
Right. We're going to unpack exactly how a traditional real estate firm is posting these massive tech-level growth numbers. So to start, we can't know where JLL is going until we know exactly where they are.
Yep, you have to look under the hood first.
Exactly. We have to look at the engine, the raw Q2 headline numbers. So what are we looking at here for the top line?
So on the top line, revenue grew 11% in US dollars, or 10% in local currency.
Okay, solid.
Yeah, and management noted this was driven almost entirely by organic momentum. But the real story is the adjusted EBITDA. It hit $273.6 million.
Wow.
Yeah, that is a massive 33% increase year over year.
Okay, wait, let me pause you right there just to do a quick plain language translation for our listeners. Because we hear adjusted EBITDA thrown around constantly on Wall Street.
Oh, for sure, it's everywhere.
Right. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. For you listening, think of it like looking at your raw paycheck, right? Just the gross amount before the government takes its cut for taxes and before the bank takes its cut for your mortgage.
That's a great way to think about it. It shows the raw earning power of the actual operations.
Right, before the financial engineering and the tax guys get involved. So a 33% jump in that raw operational earning power is huge, but the bottom line number is even crazier.
Oh, it's staggering. Adjusted EPS, so earnings per share, grew by 61% for the quarter.
Okay, I have to stop and ask about the math there, because that makes absolutely no sense on the surface.
I know, right?
Yeah, like top line revenue only grew 11%. So how does an 11% revenue jump create a 61% explosion in earnings per share? Where is this magic money coming from?
Well, it's not magic. Management calls it incremental platform leverage.
Okay, explain that.
So you have to look at the fixed versus variable costs of a global firm. JLL has a massive global infrastructure, right? They've got this huge proprietary technology stack, compliance departments all over the world, central research, global marketing.
And those are all fixed costs.
Exactly. Once that infrastructure is paid for, the cost to take on, say, one more corporate management contract, it drops precipitously.
Right. I mean, they don't need to build a brand new corporate headquarters or hire a whole new compliance team just because their leasing volume goes up by 20%. The infrastructure is essentially a sunk cost.
Precisely. So when you see that 11% top line revenue growth, that new money flows down the income statement and largely bypasses those fixed overhead costs.
Yeah.
JLL is basically making more money without having to spend proportionally more to get it.
That is the holy grail of operating efficiency. And it shows up in the cash flow, too. Free cash flow reached $438 million for the quarter.
Which is up 52% from a year ago.
Right. But, okay, let me push back on this a little bit.
Sure, go ahead.
Because commercial real estate is notoriously cyclical, a rising tide lifts all boats.
That's the old saying, yeah.
So it's easy to look like a genius when the market is hot. How much of this EPS and cash flow explosion is actually unique to JLL's specific operations versus them just getting lucky in a favorable macro environment?
That's the perfect question. And to answer it, we really have to pivot to the story behind the numbers. What actually drove these results?
Let's get into it.
So if you strip down their revenue by segment, the idea that they're just surfing a macro wave falls apart pretty quickly. You have to start with what management calls their resilient business lines.
Right, the non-cyclical stuff.
Exactly. According to the transcript, these resilient lines now make up nearly 80% of JLL's total revenue.
And that stat alone blows my mind. The broader market still kind of prices these firms as pure play transaction brokers, right? Like they live and die by the big one-off skyscraper sale.
Yeah, that's a very outdated view. We are looking at a recurring revenue service model now. For example, their real estate management services, or REMS, grew 8% this quarter.
Which is basically their facilities management wing.
Right. And you can really think of JLL acting as the physical operating system for a massive corporation's footprint.
Yeah, it's exactly like a software subscription. Like if you're a massive pharmaceutical giant, your core business is inventing drugs, not, fixing the HVAC system in your London office or planning the ergonomic layout of a call center.
Exactly. The friction of managing a physical footprint is immense.
The companies are just outsourcing the whole thing. It turns this wildly unpredictable, messy headache into a streamlined, predictable monthly operating expense.
And that's what makes this revenue so sticky. JLL embeds its tech and people right into the client structure. But while that resilient 80% provides the stability, the massive margin expansion actually came from the advisory and leasing boom.
Right. This is where they are actively taking market share. The numbers here are just insane.
They really are. Advisory revenue jumped 21% overall.
Okay.
But the defining metric is global office leasing, which grew 20%.
And this is the crucial data point because we have to compare that to the broader market.
Yes. The CFO, Kelly Howe, pointed out that based on JLL research data, the broader global market volume for office leasing only increased by 2%.
Let that sink in. The global market is essentially flatlining at 2% growth, and JLL is growing at 20%.
They are completely eating their competitors' lunch.
You do not outpace the baseline market by 1,800 basis points by accident. So what is the mechanism here? How are they doing that?
It comes down to a direct quote from CEO Christian Ulbrich on the call. He talked about this severe bifurcation in the commercial real estate market.
The whole death of the office narrative.
Right. The media says the office is dead, but Ulbrich says it's not the death of the office. It's the death of the old, unamenitized, badly located office.
Oh, totally. The flight to quality. If companies are going to force you, the employee, back to the office, they can't offer you a depressing B- cubicle farm anymore.
No, they can't. They need grade A, premium, highly sustainable spaces to lure top talent back.
So JLL is capitalizing on that.
Heavily. Premium spaces are seeing bidding wars, while secondary assets have staggering vacancy rates. JLL is capturing that 20% growth because they dominate the top-tier segment, which is hyperactive right now, while the 2% market average is getting dragged down by all the dead space nobody wants.
And we're seeing this exact same dynamic in capital markets, right?
Yep. Debt advisory shot up 44%, driven by liquid credit markets, and U.S. investment sales grew 53%.
53% growth. That is nearly double the broader market rate. But wait, this brings up the most mind-blowing stat from the entire call.
The headcount stat.
Yes, because traditionally, if your debt advisory is up 44% and your U.S. sales are up 53%, you'd have to hire a ton of new brokers, right? You'd be poaching rainmakers, paying massive signing bonuses.
Which would kill your margins.
Exactly. But they didn't do that. Over a 2-year stacked period, which included a 71% growth in debt advisory, the capital markets team increased revenue without adding any additional brokers.
None. Zero additional headcount.
How is that even physically possible? How do existing brokers handle double the deal volume?
Well, it's their secret weapon. It's their proprietary data and AI platforms. They are supercharging their existing brokers.
Basically automating the heavy lifting.
Right. Historically, a junior analyst would spend 3 weeks digging through zoning laws and leases to build one pitch book.
And now?
Now, JLL uses large language models on their massive internal data lake to do it in a few hours. The AI handles the rote data processing, which lets the human broker focus purely on negotiating deals and managing client relationships.
So the software is literally acting as a multiplier on human output.
Exactly. And it's working so well that their software and tech solutions segment actually hit profitability in the fourth quarter of 2025.
Wait, didn't they project that wouldn't happen until 2027?
They did. They beat their own internal target by over a year.
That is wild. It proves the tech isn't just an expense anymore. It's a massive profit engine. But okay, to keep things balanced and impartial, we need to report on the headwinds. It wasn't all perfect, right?
No, there were definitely some bearish notes on the call. First, in the U.S., they faced a temporary margin headwind because brokers hit their higher commission tiers much earlier in the year than usual.
Right, because the deal sizes were just so massive early on.
Yeah. Once a broker crosses a certain revenue threshold, the commission split favors the broker more and the house less. So the firm paid out a higher percentage of revenue to brokers in Q2.
Kind of a high-class problem to have, honestly. But what about geographically? I know there was some regional softness.
Yes, specifically in Europe. Management pointed to highly elongated investment sales timelines in parts of Europe.
And what's driving that?
Well, management explicitly attributed it to the psychological caution of investors due to the ongoing geopolitical conflicts.
The war in Ukraine and the conflicts in the Middle East.
Exactly. We're just impartially reporting management's perspective here, but they see this as a factual driver of market hesitation. The capital is there, but European investors are perpetually delaying final signatures because of the geopolitical uncertainty nearby.
Right. When there's kinetic conflict 2 borders away, locking up 100 million euros in an illiquid 10-year asset suddenly feels a lot riskier.
Yeah, and Obrich mentioned that hesitation is even bleeding into Asian markets like India.
So given that, we have to talk about management's guidance because the market is always forward-looking. What are they promising for the rest of the year?
This is where things get really aggressive. They raised the bar massively. They bumped their full-year adjusted EPS target to a range of $24.60 to $25.90.
Okay, that is a 34% growth target at the midpoint.
Yep.
But wait, let me push back again. With Europe lagging so hard and all these geopolitical tensions, isn't raising EPS guidance by that much a massive risk for management? If Europe stays frozen, how do they hit that?
It's a valid concern, but management is pointing to their sheer dominance in the U.S. market to carry the load.
The U.S. is just carrying the team on its back.
Pretty much. That, combined with their one JLL cross-selling strategy across that huge 80% resilient revenue base, gives them a ton of confidence. Plus, you have to look at the balance sheet.
Let's get into the capital allocation.
Their net leverage ratio improved from 1.4 times a year ago down to 0.7 times.
Okay, let's briefly translate net leverage ratio into plain language. It's basically total debt minus cash divided by adjusted EBITDA. So for you, the retail investor, just think of it as the corporate version of your personal debt to income ratio.
Right, exactly.
And going from 1.4 to 0.7 means they are highly, highly financially secure. They have fortress level liquidity right now.
They really do.
Yeah.
And they are using that liquidity to aggressively buy back stock. They bought back $110 million in Q2.
Wow.
And that brings them to $410 million for the first half of the year, which reduced their total share count by about 3%.
Okay, why does this matter to the listener? Think of the company's total shares like a pizza, right?
The classic pizza analogy. Love it.
It works. If management buys back shares and retires them, they are basically removing slices from the pizza. But the pizza itself doesn't get any smaller, so the remaining slices, the shares you hold, just get mathematically bigger and more valuable.
Exactly. And the kicker here is they still have $2.6 billion authorized for future share repurchases.
$2.6 billion. That puts a massive multi-billion-dollar floor under the stock price.
It really does. But before we get to the bottom line, I want to highlight one hidden gem in the transcript that is a huge tailwind.
Oh, the data centers. Yes, let's talk about this.
It's buried in the supplementary text, but JLL manages 340 data centers right now.
Which are arguably the most complex physical real estate assets on Earth.
Oh, for sure. The cooling, the power grids, the security. Tech companies don't want to manage that stuff, so they outsource it to JLL. And JLL projects their gigawatt capacity is going to grow by 1/3 in just the next 2 quarters.
A 33% capacity expansion in 6 months. That is insane. It ties JLL directly to the broader global AI infrastructure boom. They are literally managing the physical layer of the AI revolution.
They are capturing highly predictable, recurring revenue from the biggest tech companies in the world.
Okay, this brings it all home to part 4, the bottom line. We have the data, we know the story, we see the guidance. Now, what does this actually mean for you as an investor?
Well, I think we have to take a decisively bullish stance on JLL's Q2 results.
I completely agree. Highly bullish. And why is it so strong? Because, like we said earlier, it's not just a rising tide lifting all boats.
No, not at all. Their 53% U.S. investment sales growth versus the broader market proves they have a tangible structural moat.
Right. And you made a great point earlier synthesizing this. That moat isn't just old school relationships anymore.
Exactly. Historically, if a star broker left a firm, the revenue left with them. But now the moat is the AI and the proprietary data platform.
Which allows their brokers to close vastly more deals without the company having to increase headcount.
Right. The intellectual property is embedded in the platform now, not just walking out the door in an expensive suit at 5 p.m.
So, actionable advice for the listener. If you are holding or considering this stock, JLL is frankly no longer just a traditional commercial real estate play.
Not even close.
It's actually a backdoor play on three massive global trends. First, corporate outsourcing and facilities management. Second, the massive AI and data center infrastructure build-out. And third, the tech-driven productivity boom in professional services.
And don't forget the safety net. With $2.6 billion locked and loaded for share buybacks, management is actively putting a floor under the stock price while all this growth happens.
Absolutely. So to quickly recap our journey today, we started with a 61% EPS explosion, walked through how AI is driving insane broker productivity, and unpacked the massive guidance raise backed up by billions in stock buybacks.
It's a completely transformed business model.
It really is. But to wrap up, I want to leave you, the listener, with a final provocative thought to ponder on your own, something that builds on what we read in the text today.
Ooh, I like this. Lay it on them.
So JLL just proved definitively that they can drastically increase revenue without hiring a single new broker, all thanks to their tech and AI platform.
Yeah, the 71% debt advisory growth with flat headcount.
Exactly. So if this is where we are in 2026, what does the commercial real estate job market look like in 5 years?
That is a scary thought for some.
Are we heading toward a future where a tiny, elite handful of super brokers who are completely powered by massive AI mainframes handle 90% of all global transaction volume?
Basically boxing out everyone else.
Right. Does this completely box out the smaller, traditional real estate firms who can't afford to build $1 billion AI data lake? It's something to think about as this industry consolidates.
It really is. The gap between the tech haves and the tech have-nots is only going to widen.
Definitely. Well, that wraps it up for today. Thank you for joining this deep dive. And as always, keep looking past the headline numbers. We'll catch you next time.